Mayuresh Joshi is joining in. Mayuresh, let's start by talking about Infosys actually. That stock is on the move as we say hi to you. I mean, given what TCS delivered and the market's lofty expectations, we saw the reaction to what was actually a good quarter. How would you approach Infosys from a stock point of view?
Afternoon, Surabhi. I think clearly going in with results expectations, I think it's a 2.5% dollar revenue growth on a quarter-on-quarter basis. And the obvious impact that one probably sees in terms of margins, because wage hikes will probably come through in this quarter. So I think the entire offsetting effect in terms of a weaker rupee against the dollar will be offset because of the wage hikes. But what has interestingly happened is the TCVs. So in Q1, Infosys had $1 billion TCVs that they reported. In Q2 itself, I think as per media reports, there is almost $1 billion of TCVs in terms of two large deals that they have signed up. So I think the TCVs or the deal wins are happening at a very fast clip. And the management is very, very hopeful in terms of the 3-year strategy, that the stability year that we're looking at this year, both in terms of revenue accretion as well as pricing probably remaining very, very constant, reflecting in volume growth, should probably be the order of the day. Having said that, again, I think on the valuation perspective and expectations of attrition levels actually coming down, because that is a huge concern that the market has at 20-odd%, and their execution patterns, maintenance of constant currency growth rates and EBIT margins is something that the management, in my opinion, should go with. So I think the whole rating probably continues at this point of time for Infosys.
Okay, Mayuresh, good afternoon. I wanted your thoughts on IndusInd Bank and how to approach the stock now.
Afternoon, Anuj. So I think if you look at the qualitative aspect of the numbers, the NII growth was stupendous. The loan growth at 32% was equally good as well. Now, what is irritating the street is probably the provisioning figure, the kind of exposure that they've got to ILFS. I just had a ticker on your screen that a few of the restated or the restructured accounts also belongs to the unfortunate situation in Kerala. And again, I think if you look at the patterns in terms of the NIM compression, obviously I think fixed rate contracts is one element to the whole argument. The other argument also becomes that they've raised deposit rates, but the lending rates happens with a lag. So I think the softness in NIMs is expected to probably stay around these levels. At the same time, when you're probably talking about asset quality, I think the asset quality in terms of absolute GNPAs that they've reported, I think look pretty reasonable. So I think the kind of credit cost estimates that one really builds in, even with the elevated provisioning, should not exceed the kind of standards that the bank has laid out. So I think the growth has been pretty good on a few parameters. I think these aspects, specifically the softness in NIMs, what happens to the ILFS exposure and the exposure towards the SMEs, specifically in terms of regions out of the south and Kerala, I think that might take a toll in terms of near-term earnings. But the long-term outlook obviously remains very, very robust. So I think anybody holding onto the stock should continue holding it.
Okay, let's just go back to two of the consumer stocks of the day, both that have had a disappointment in terms of market reaction. Lever, which is still down 2.5%, so there's a minor spike from that low level that we're getting right now on the stock. So there's a bit of a improvement, if you want to call it that. And the other is Avenue Supermarts. Mayuresh, your thoughts, because again, this was a case where the market went in with pretty solid expectations, and obviously 10% volume growth wasn't enough. I mean, I guess the market wants to see more on margins, on pricing, etc. Would you buy a stock like Lever or even Avenue when you're getting this decline?
So, Surabhi, again, I think as you rightly pointed out, I think the numbers were quite reasonable in my opinion, because you're coming out of a very seasonally weak low base here in the quarter gone by. Having said that, again, I think the growth that you've probably seen, both in terms of the personal product segment and the other segments, I think the EBIT margins also have held up pretty well. So when you're talking on one hand in terms of input cost inflation, on the other hand, I think pass-through, which has probably happened in terms of realizations, both in terms of price hikes taken and the expectations of probably entrenching their distribution reach directly. And again, I think the mini Indias that the management has talked about and the innovative SKU products that they're probably bringing onto the table, I think it's commendable that the management is still sticking on to a reasonable amount of volume growth, though the numbers have not been divulged. I think a double-digit volume growth, I think, should be very, very reasonable for a stock like HUL. Now, for stocks like HUL and DMart, I think valuations obviously have been on the higher side. So any disappointment in terms of what the street expects and what they deliver is going to play on the price. For DMart, again, I think the franchise that they operate out of, both in terms of the revenue per square feet, the constrained way in terms of building up new stores. And again, I think the cost constraints that they probably have in terms of optimization, which clearly reflects it in EBITDA per square feet, I think is phenomenal. So again, I think valuations might be the only argument that do not go in favor of these stocks. But yes, anything on declines on a stock like HUL becomes a buying opportunity.
Okay, by the way,
Mayuresh, let's take final thoughts with you as well. Anything that's kind of caught your eye? Any stock idea you'd like to leave us with?
Yes, sir. I think music broadcast is something that we believe can do well from the current levels. Obviously, the utilization of their new radio stations is working in their favor, along with the price hikes that they've largely taken across the board. So I think the combination of price hikes plus utilization improving across the board will definitely improve their operating leverage. The management is very, very confident in terms of a double-digit volume growth going forward, and the ad rates and the ad volume growth should sustain as well. So I think EBIT and EBITDA margins staying well above 32-33%, specifically on the EBITDA front, should provide the support. And the capex has largely been done. So I think the fixed cost absorption should largely be behind them, which should ensure that the operating cash flows improve significantly over the next 2 years. And there is every chance that the government, that the company might mete out a significant dividend over the next 2 years as well. So I think music broadcast, both in terms of earnings and valuations, looks very, very attractive.
Okay. All right, gentlemen, we'll wind up on that note. Thank you very much for joining in and taking us through market close today. A green close to start the week off. We have to take a break. On the other side,